Participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Vijay from GM Financial. Thank you, and over to you, sir.
Thank you, Raman. Good evening, everyone. Thank you for joining this call today. From the management side of Nippon Life India Asset Management, we have Mr. Sandeep Sikka, PD and CEO, Mr. Fujikake, nominee from Nippon Life Insurance, Mr. Pratik Jain, CFO of the company, Mr. Chatterjee, who is the Co-Chief Business Officer, Distribution, Mr. Ashwin Duggal, who is the Co-Chief Business Officer, Institutional, Mr. Saha, Head of Digital Business, and Abhishek from Investor Relations. Without much ado, I'll hand over the call to Mr. Sikka. Over to you, sir.
Fine. Good evening, everyone, and welcome to our Q4FY20 earnings conference call. We have with us Pratik Jain, Chief Financial Officer, Saugata Chatterjee, Chief Business Officer, Distribution, Ashwin Duggal, Chief Business Officer, Institutional, Arpan Saha, Head of Digital Business, Fujikake-san, nominee of Nippon Life, and Abhishek. I am happy to share that post change in principal shareholding in October 2019, NAM India has grown and has regained its lost market share and investor base. We have seen green shoots with induction of more than 290 new corporate and SME investors who have started investing with us post this transition. The rebranding exercise has been successfully completed and is yielding favorable results. Since September 2019, our mutual fund assets have grown despite a very challenging macro environment. On a monthly average basis, the AUM touched a high of rupees 2,210 billion in February 2020 as compared to 1,886 billion in September 2019. Owing to COVID-19 crisis and subsequent volatility in the capital markets, Nippon India Mutual Fund fell down in line with the industry by March end, and the quarterly average AUM was 2,049 billion. We continue to have one of the largest retail AUM in the industry at rupees 444 billion. Our aim is to increase our base of retail investors, especially from B30 locations. The contribution of retail AUM to total AUM is amongst the highest in the industry at 24%. Our SIP folios increased to 3.2 billion as on March 2020. The progress highlights of our retail execution capabilities during the challenging period. The analyzed SIP book is at rupees 97 billion. During the year, the new digital SIP registration grew by 56%, and 86% of the incremental SIPs have a tenure of greater than 5 years. We continue to be amongst the leaders in the beyond top 30 cities category. The category contributes an AUM of rupees 321 billion. Over 17% of the total assets are sourced from these locations against an industry average of 15.6. As on March 31st, 2020, 68% of the individual assets have a vintage of more than 12 months as against 63% as on March 2019. We are the second largest ETF player in the market, having a market share in excess of 16%. In this segment, the AUM rose by 39% to rupees 295 billion. Excluding the EPFO allocation that goes to 2 PSU-owned mutual funds, we are the largest ETF player in the country. I am happy to share that the digital platform contributed 45% of our new purchase transactions. Our investments in digital ecosystem is yielding results, and transactions grew by 31% to 1.4 million over the last financial year. We are We have ongoing tie-ups with 20 prominent digital partners. Nippon India Mutual Fund remains well diversified in terms of distribution, with no single distributor contributing more than 5% of the AUM. We have over 76,200 distributors empaneled with us. During the year, we launched Nippon India Digital Innovation AIF, a fund of funds in technology and venture capital space, which received commitments of approximately $100 million from marquee investors in Japan. In our offshore business, the assets under management and advisory rose to rupees 89 billion. Now on our financial performance. For the quarter ended March 31st, 2020, the revenue from operations was 2.7 billion. Operating expenses decreased by 34% to rupees 1.2 billion. Despite a 12% fall in quarterly average AUM in Q4FY20, the operating profit remains stable at rupees 1.5 billion. On average, overall operating expenses have declined by 10% every year over the last 4 years. As on 31st March 2020, our financial assets are rupees 24 billion. Of this, 12% is invested in our own equity schemes, 57% is invested in our debt schemes, and 25% in bank FD and tax-free bonds, and remaining is in sundry assets. This proportion has remained similar over the last few quarters. Domestic equity markets extraordinary volatility in March 2020, whereby the benchmark indices declined by 25%, while the mid-cap and small-cap indices declined by 40 to 46% respectively. As a result, there was an unrealized mark-to-market loss in excess of rupees 1 billion in Q4. Due to this, the profit before tax decreased to rupees 274 million for the quarter ended March 31st, 2020. For the year ended March 31st, 2020, the profit before tax was rupees 5.6 billion. The M2M losses are notional and unrealized. We have already recouped a part of this loss driven by the favorable market conditions post 31st March. With regard to our response to the COVID-19 crisis, we implemented 100% work from home in March 2020. Since then, all business operations, including investor purchase redemption transactions, have been executed without any disruption. On average, over 140,000 purchases were executed through digital mode in March 2020, an increase of 30% over the monthly average for the previous 11 months. Since March, our sales team as well as the portfolio managers connected with more than 10,000 investors, conducted 80 phone calls and webinars. For our distributor partners, we conducted over 135 online learning training sessions and engaged with more than 5,000 partners during this lockdown. A strong risk management framework continues to be bedrock of our business. Over the years, we have built a detailed fund casing framework for every fund with an in-depth research-driven process and assigned dedicated responsibilities to individual fund managers in line with the fund objective. To strengthen the framework further in these volatile times, the board decided that to make fresh investments in fixed income in only assets which are AA and above for all mutual fund schemes except Nippon India Credit Risk and Nippon India Hybrid Bond because of the SEBI categorization. I would again like to reiterate, the board has taken a decision that in fixed income, all mutual fund schemes will be investing only in AA and above. I am happy to announce the board has proposed a final dividend of rupees 2 per share. With this, the total dividend for the year is rupees 5 per share. In FY20, we consolidated and grew our business amid unprecedented challenges. Post rebranding in October, we saw the AUM recover on a fast track till February 2020. Despite external hurdles, our operating performance remains strong, driven by retail strength and control on cost. We will continue investing in our AIF, ETF, and offshore business for future growth opportunities. We are confident towards regaining the lost market share and increasing our profitability in coming quarters. With these comments, we are happy to take any questions. Thank you.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. We take the first question from the line of Rushabh Dalal from CRSSB. Please go ahead.
Yeah. Hi. Thanks for the opportunity. Am I audible?
Yeah. Please go ahead, Rishabh.
Yeah. Just while going through the income statement, I just came across the other income where you have mentioned that 124 crores as a negative figure. If you could please explain the rationale behind it and how much of that has been recovered. In the sense that, you said something about mark-to-market losses, but if you can, please explain it in detail.
Sure. So, Prateek?
Rishabh, this is Prateek here. Rishabh, you have to see, basically, the company has a net worth of close to about 2,900 odd crores, of which predominantly almost 70% has been invested into our own mutual fund schemes. Close to about, if you take the FDs and the tax-free bonds, if you take all these together, close to about 95% of the money has been, of this 2,900 crores have been invested into our own schemes, tax-free bonds or fixed deposits. So of the total amount, if you see 1,800 odd crores is in our mutual fund, of which typically, we have been allocating close to about 12 to 18% into our own equity scheme. It is part of our seed capital, also our treasury investment. Now, of the total on the equity side, close to about 400 odd crores of investment into our ETF schemes and our equity schemes. On the 400 crores, if you see from March 1st to March 30th, there was an overall decline in the benchmark indices of about 30%. And going by the same thing, we have seen almost about 26% kind of a decline in our, these portfolio. And that is what Sandeep was alluding to, that these are mark-to-market impact on our scheme investments. Please note, we do not take any kind of direct exposures into any equity or any other mutual funds equity schemes. So all these investments pertaining to in our own equity schemes and ETF schemes, which has, due to this unforeseen black swan kind of an event, have a decline in terms of MTM value.
Right. Just one more follow-up question on this. You said that 26% of the portfolio has, declined in the period from March 1st to 31st due to the unprecedented crisis. But if you could, give me some figure as to how much of that has been recovered post the recovery that we have seen in the indices.
I'll tell you, basically this is a very dynamic figure and, obviously then becomes, the information for the current quarter. But, what we're saying is that is available, from our NAVs, if you see the, NAVs of our schemes where we have invested are available, in public domain, you can do that. But yes, a significant part of it has been recovered, post this 31st of March, because markets has come up about 20 odd %.
Okay. Yeah. Thank you. Yeah. Thanks for the opportunity.
Thank you.
Thank you. The next question is from the line of Jatin Kumar from Alpha Capital. Please go ahead.
Hello, sir. Thanks for taking my question. So my first question would be, if I look at this mutual fund industry data, April was also degrowth for our AUM in terms of equity also. While equity markets have recovered, our equity as well as debt AUM have degrown in April. What would be the reason for that, sir?
I think it's the way, I think you have to see is, I think it's not that the whole thing has recovered. The fact remains that April has also been one of the most turbulent months. So I would not like to comment anything, beyond 31st March right now in this call. But clearly, I think these are, volatile times. It will always be, for us, the backbone of our growth is we have today 3.2 million SIPs, and this is the retail flow which continues. So you will always have HNI money which will come and go, and which is more, especially during these volatile times. But from a sticky sets point of view, we are happy that I think SIPs continue to grow.
Sure, sir. And sir, on a broad base figure, what would be our equity revenue as a percentage, as in our equity AM, how much that would be contributing to our revenue in terms of total?
Yeah, Jatin, we do not, disclose, the individual breakup, but let me share with you that, in terms of our overall operating revenue, we are, for the year, we are about 55 basis points. And in terms of the net margin, we are about 27 basis points. So from the last years where we had a net margin of 21 basis points, we have improved our operating profit to about 27 basis points. So despite these challenging times, because of our relentless focus on operating efficiencies, we have been able to improve our operating margins.
Sure. I agree, sir. And my last question would be, this employee expense and other expense have gone down quite a bit in this quarter. What would be the sustainable run rate for these two numbers?
Yeah, so, we have always been maintaining that, our significant part of our, salary is variable. We have on record said that 20 to 25% of our salary bill is variable. And, obviously, in terms of in the current scenario where, the number, for the financial year, there has been certain reversal or the lowering of our small term PLI and also the long term incentives, which has resulted in the, almost about 30 crores of reduction in terms of quarter on salary bills.
And other expenses?
So in other expenses, if you see, again, we have been mentioning that, there is a reduction of about 20 odd crores when you look at a standalone basis. Predominantly it is because we have been working, improving our operating efficiency. But this time, the large part of it is from the marketing spend and the other discretionary spend. We have always been maintaining that, in the times, we can reduce them and, control them. And so this quarter, this discretionary spend on marketing and other digital, etc., has been lower. And therefore, this is the number for the, we saw the 20 crores reduction in our other operating expenses.
That's it from my side. Thank you.
Thank you.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Anand Trivedi from Nippon Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. First question is a clarification. The other income which has come down from 56 to 112 crores negative, is that primarily because of equity or is there also some debt mark-to-market component in that?
No, see, of course, on an NAV basis, marginally that would have been the case, but predominantly it is on our portfolio investments into our own equity schemes and our ETF schemes.
So to answer the question, it's the seed capital which has been put in equity, mutual funds, and ETF.
I understand that. Thanks. The second question is, in your expenses, year over year, your fee and commission expenses has come down from 56 crores to 3 crores. Can you explain why it's come down so much?
Yeah. So this is the expenses which industry used to historical pay as upfront commissions,
Okay.
which used to amortize in the books. But post the regulation, these expenses are upfront brokerage are not allowed, and trail expenses are amortized in the schemes.
So the 3 is then the more sustainable number. Is that a fair way of looking at this?
Yeah, these are the numbers which is pertaining to the unamortized part of the longer duration or close-ended funds, and also some part of it is pertaining to the PMS and AIFs in the consolidated one.
Okay, thank you so much.
Thank you very much. The next question is from the line of Nikhil Chaudhary from Akash Ganga. Please go ahead.
Sir, thank you for the opportunity. Sir, my question was with respect to the newspaper article in Feb 20, wherein the regulator has issued an order in our favor in respect of the Reliance Capital dues. So, have we reversed the amount of 320 crores which we had provided? I just wanted to get a sense on that.
So, I think first, let me share with you. I think as far as the Reliance Capital, there is no exposure of Reliance Capital in the AMC. The financial assets of the industry, of the AMC, we do not have any exposure to any Reliance Group company or any other company other than our own mutual fund schemes. I think that is number one. Number two, the exposure which is in some of the schemes, it's under litigation. I think we will not be able to comment too much about it, but I think we are making significant progress on that.
Okay, sir. Okay. And sir, could you share the Nippon's SIP closure rate? Like yesterday, I understand there was an article wherein the SIP closure rate was 70%, 72% for the industry. So if you could share some number in respect of Nippon, that would be great.
I think broadly for us, we are in line with the industry. Fortunately, I think the only thing, because our SIPs are very retail, the stickiness is much more, and we have 80% of our SIPs are greater than 5 years.
Okay. Thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Haresh Kapoor from IIFL Asset Management. Please go ahead.
Hi, sir. So just coming back to this other income, if you could just talk about the absolute value of impact and the normalized other income, excluding the M2M hit, what would that number be for the quarter?
Yeah, so if you see, in terms of the normalized income, if this is close to about 140 odd crores of mark-to-market income, and the rest is the other income which you've. Because see, you have to see even the debt schemes. While there is no impact on that, but the debt schemes are also construed as MTM only.
No, so my question is, so in the presentation it mentions above 1 billion. My question is, what is the exact value of M2M hit for your Q4 quarter? So if you could just give that number out.
Yeah, so
absolute M2M hit for the quarter.
Yeah, so absolute MTM hit as is close to about 149 odd crore. Thereabout.
Okay, so basically, if your quarter on quarter 57 crores in Q3 would have more or less been your approximately 27 crores or so for this quarter, the normalized other income.
Yeah.
Is that right?
Yeah.
Okay. And so, sir, so that's all other income. The second question just around this, the cost front. So obviously you mentioned the key reasons for that, but going ahead, how do you look at for the quarterly run rate in terms of the other expenses? Because as you rightly mentioned, it's also a discretion. but markets are where they are. We might need some push on the marketing front too, to kind of get our brand to the clients. So, we have reduced in Q4, but how do we look at it immediate quarter or, Q1, Q2, where, we might need some push on that front too?
Yeah. So see, Harish, if you see consistently, we've been clocking in the range of 150 crores thereabout. And, importantly, we have also been, if you've seen in the last 3 years, and it is part of the presentation also, our other expenses have been significantly coming down. So I think, we will be definitely be, I would say the north of 150 crores per quarter in terms of the overall expenses, other expenses.
Just to add to it, we are not trying to cut any cost which will have impact on our long-term growth. I think the discretionary cost that we're talking of. So we keep investing into digital because I think and the cost cutting that is coming is also the fact that today when 50% of your transactions are coming through digital, I think the operational cost is also coming down. So yeah. I want to just assure you that I think from our point of view, we'll be closely looking at all discretionary cost, but we will not be cutting any cost which can impact the future growth of the company.
Yeah, I just want to reconfirm. So, did Mr. Prateek just say that going ahead will be 50 crore run rate? So this 112, 113 crores becomes 150 crore on a normalized run rate basis where we will be investing in the business and, whatever push it needs. Is that right? 150 crore is the number basically.
No. So see, if you, again, there are multiple components to it. If you see, in terms of the other expenses, you have seen that 46 to 60 crore, obviously, there is a bit of variability in terms of the other expenses on one side. And the other part is, the other bigger item is our employee benefit expenses, which has been in the range of about 75 crores per quarter. Obviously, that was basis the, as I mentioned, there are variable component to it as well. Now it will all depends, how, this year pans out. So, but what I'm saying is that in terms of the steady run rate, it was about 150 crores. And given the variability, we can always bring it down, depending on, how much we have to invest in terms of marketing as well as in terms of the providing for the long-term incentives as well as PLI.
Okay, fine. And next question just around this quarterly revenue run rate. Now, obviously you have had some, on the total AUM basis has been pretty steady, and you have also started gaining some traction in at least in Q4 was on the debt front and some mix change there. But, little positive on the AUM front, but approximately 9.5-10% down on the revenue side on a quarter-on-quarter basis. So is it just the mix change front, or is it something more in terms of some yields changing or something on that front too?
No, so, two things. One is the predominant part is the mix front. Obviously the mix has changed in the fixed income side. Most of the duration and the credit where we used to earn, slightly more money is now come into in form of a liquid and very, very ultra short term kind of a category. Also there, because of the yield compression, we have reduced certain expenses. So basically, that is the predominant reason for that.
And this last thing, so this, spoke about April in particular, we had pretty decent trajectory in Q4. Some of the debt initiatives, some of the liquid initiatives seem to be on a positive note, but can understand the equity hit that we've had because of M2M. But even in April, we had some impact on the debt side and, some of the other impact in AUM. So coming back to that, so is this some particular segments, as you mentioned, which are seeing that investment and outflow, or how should we read through? Because debt momentum was good, and in the month of April, obviously had some decline. So how should we read through on that front?
See, I think the way you have to see this in April, I think again, because we're talking of March results, I don't want to touch too much to April, but I think just to give you saw a lot of in industry, there were a lot of events which happened, we being a part of the industry, we also get impacted by that. So some of the credit funds, we saw the impact because of some industry player, some event in some with the industry player. So I'll just like to put it, there's nothing specific with any segment. I mean, whenever events as big as what happened in April happen in the industry, everybody gets a little bit impacted.
Okay. And no other subcategories or subsegments that we are seeing meaningful hit other than credit funds?
No.
Okay.
And I would also like to touch this. Credit funds for the industry are less than 5% of the AUM.
Yeah. Sure. Great. Thank you. And good luck ahead.
Thank you.
Thank you. The next question is from the line of Pritesh Chedda from Lucky Investment Managers. Please go ahead.
Yeah, sir. I was a bit confused on the expense line side. So I think when you're referring to 600 crores, probably you're referring to total expense including depreciation number? Because last year's full year expense is about 572. So I think, are you taking that number in consideration? Because when you say that there is variability in expense and employee expense has a variable component and other expense has a variable component, then whatever was your run rate quarterly and what came in the quarter four, your expense line ideally should then land up between the two numbers for FY21. Is that the interpretation we should make?
Well, we are not in the business of giving guidance, but most of these expenses, as you've seen and as you rightly pointed out, would be, following this kind of trajectory. So, obviously, by your, the way you articulated it, it would be between 550 to 600.
That's including depreciation, right? Because that's the total expense line I think you're referring to.
Absolutely. Yeah.
Perfect, right? Yeah, that solves the problem. Thank you very much, sir.
Yeah.
Thank you. The next question is from the line of Ritwik Sheth from Fanak Financial.
Hi, good evening and thanks for the opportunity. Sir, a couple of questions on the employee cost. Is it linked to the NAV of the schemes or?
No. Employee costs are not linked to the NAV.
Go ahead.
Yeah. See, employee cost is not linked to the NAV. However, most of the research firms just put across into their research reports, the expenses as a percentage of AUM or the total expense as a percentage of AUM. So otherwise, this is, but Sandeep can dwell on in terms of PLI, how, performance is rewarded or, underperformance or how, PLI are paid. Sandeep, you can allude on that.
I think broadly it's not linked to NAV, number one. I think it is linked to overall the company performance, individual performance and team performance. So I think broadly about almost 1/3 of the total compensation is variable for the key people. And it is basically, that is the discretionary part that we talked about.
Sure. Okay. And just going on to the expense part, on the other expenses, you mentioned that we had lowered the marketing expenses in the quarter. So so should we link the April loss of equity market share versus the industry somewhat to this, or this was purely because of the NAV and the volatility in the market? So
I don't think so. There's a direct correlation between investing money in 1 month and getting market share in the next month. I think it's a franchise that has been built over 20 years. And I think it is not the, so I think I would like to, again, maybe this comment has been taken a little differently. We will be looking at discretionary cost, I think. It does not at any time mean we'll stop investing in initiatives, activities and investments which will help us grow in future. So at no point of time, I think the cost cutting will not be done at the cost of future growth.
Sure. And last question is on the what would be the effective tax rate for us?
Yeah. So, see, we have chosen to be, go for the lower tax rate. However, in terms of this MTM, losses, which is more of an accounting losses, we do not get any kind of tax break. and hence you see the effective tax rates being, appearing as higher.
Yeah. I got that. But tax rate would be 25%.
Yes. It will be 25%. Typically for us, when in a good scenario where we have other MTM income and, when we realized most of our other income basis, long-term gain. So, and that is, tax lower rate, and therefore our effective tax rate will be lower than the maximum marginal rate.
Right. Okay. Sure. And just one last question on the 2,900 crore treasury money that we have invested. If I got it right, it is 400 crores in equity mutual fund schemes of our own company, and 57% is debt, and the balance is FD and
tax-free bonds.
Tax-free bonds. Okay. Great. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Madhukar Ladda from HDFC Securities. Please go ahead.
Hi. Thank you for taking my question. So first on this other income and your composition of investments. So on slide 41, you've put out the complete composition. So, what are these other assets of 158 crores approximately?
Yeah. So those are actually, one is that these are the trade receivables, and these are, specifically these are, our investment into our own AIF and our subsidiaries.
Okay. You've included that as well. Trade receivables also included in this, or only?
So these are the total breakup of total financial assets.
Okay. And trade receivables come under financial assets?
That's right.
Okay. Got it.
Effectively everything, Madhukar, whatever is there is within the company and within the mutual fund schemes.
Right. So can you give a breakup of this mark-to-market loss of roughly 150 crores between equity, debt, and anything else?
So, frankly speaking, there is zero. See, first of all, we have no investments outside of this. Okay,
Right.
Of our own scheme, etc. And therefore, if you see the entire mark-to-market loss is on our own investments into our equity schemes and ETF schemes.
Understood. But can you just quantify how much will be equity and ETF and how much will be debt? Because as of March, the equity MTM amount is about 281 crores, whereas debt is 1,400 crores. Now, even if you take a 30% odd hit on equity, then you're roughly coming to about 100 crores sort of a hit number.
So, everybody is alluding to get the precise number, so fair enough. See, almost about 415 crores was there, and which almost equally divided between the ETF and in our equity scheme.
Okay.
So if you ask me what is the breakup of 280 right now, I can give you that because that is the published number. So the 280 is now 147 in our equity scheme and 133 in our ETF scheme.
No, but what is the written down value, Pratik? I think what Madhukar is asking.
That is what I'm saying.
Before that, the value was roughly about 385, about 400 roughly, 380, 400, which effectively 30% comes down to about 130 crores negative.
Okay, so that negative number is about 130 crores, and the debt is about 20 odd crores. So understood. And on the expenses side, what would be, given these numbers now for the full year, we have staff cost of, our staff cost is about 300 crores, and other expenses are about 221 crores. So what would be within these expenses, what percentage would be fixed and what would be discretionary? Can you give a little bit of flavor on that?
As I mentioned earlier, I think in our total fixed salary cost, 1/3 will always be discretionary, which is with the variable pay.
Okay. And in the other expenses?
So other expenses, Madhukar, as we mentioned that, close to, again, it will all depends on in terms of the, fee and brokerage, so these are all variable expenses. And in the years where business are good.
Exclude fee and commission expense.
Yeah, so that has been in the range of about 50. So if you see, that has been in the range of about 50 odd crores. So, in a good times where Sandeep is saying that we invest into our discretionary spend is go to 60 odd crores. And, in a bad time where we want to squeeze it, we can bring it down to about 45 odd crores. So you will see that it's in the range of between that.
Understood. Okay. And one final question. You had these phantom stock options at the time of IPO. Has all of that been settled now, or is there still some mark-to-market pertaining to those in the employee expenses right now, or is it all closed out?
No, so as I mentioned that the reduction in the salary for this quarter is predominantly part of the two things. One is the immediate for the year PLI, and also in terms of part is due to the long-term incentive, which is in form of phantom, the valuation of that. So it is combination of these two things.
Okay. So when do all the outstanding, right now we are not issuing any more phantom, and when do all the phantom stock options get closed? So when do they finally get settled? What is the outer date on that? And yeah.
So next financial year, that will complete the 4-year period when it was granted. So next financial year it will get, not the current one, the next financial year it will get closed complete.
March 22.
Yeah.
Okay, that's it from my side. Thank you and all the best.
Yep, thank
you. Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from the line of Viraj Mehta from Equirus Portfolio Management. Please go ahead.
Yeah, my questions have been answered. Thank you.
Thank you. We move to the next question. The next question is from Kunal Shah from Carnelian Asset Management. Please go ahead.
Most of the questions have been answered. Just 2 questions. In the quarter, the fee and commission expense has increased from 12 crores to 19 crores. If I understand correctly, these expenses are the ones which were prepaid before those circular came in, where all these expenses have to be debited directly to the schemes. So any reason why this has gone up from 12 crores to 19 crores, and what is the pending amount going ahead which will be debited in the next financial year? That is the first question.
Okay. Sorry, yeah, put your second question as well.
The second question was pertaining to, now we're seeing a flight of safety where a lot of money, be it liquid or debt, moving to probably say banks which have got AMC houses, right? And also as far as the equity schemes go, it is more kind of linked to the performance of the schemes where it gets pushed by IFS. Now, looking at both the scenarios where, probably we don't have a bank as a channel partner, right? And Nippon is new when it comes to branding, as it was earlier known as Reliance. And also on the backdrop of equity schemes having a lackluster time. What is the feedback that we get from IFS when it comes to getting incremental business?
So I think firstly, I'd like to highlight the fact, yes, we've not been a part of the bank. We're not a bank-sponsored asset management company. And we do not take that as at any point of time as a disadvantage. I think we are today supported by all banks, and our biggest strengths have been the IFAs. So I think I do not see that I think being a part of the bank gives you extra advantage or does not give you, not having it as in it, because as long as you have a well diversified distribution mix, the sigma of that together takes care of it. That is number one. Number two, I think the question of whether investors will now move to bank sponsored for safety, I don't think so. I think that is not the case. I think today every company comes from the, I think it's more to do with the institution which is backing it. Today, I think we clearly see, especially the HNS and institutional investors, clearly see Nippon as a Fortune 500 company, and the kind of response we are getting from these investors post the name change has been very, very positive. Coming to performance, flows coming to few schemes. Yes, we've had some schemes which have not been doing well, but at the same time, we've had a couple of equity schemes which have been doing very well, the value fund, the growth fund, and some other funds, and we have been seeing good flows coming into it. Having said that, our long-term approach will be that we'll be working on consistency of fund, the performance of the schemes rather than being in the top three, because we believe that is not a sustainable top one or two, because that type of performance is not sustainable from a long-term point of view. So the way you have seen we have done in fixed income, I think we are one of the first asset management companies to put out with a formal board policy that we will not be going below AA. I think we are moving more towards a conservative approach in fixed income and consistency in equity.
Yeah, in terms of your first question, if you see, two set of our results. One is the standalone. There, this fee and commission expenses have come down, from 7 crores to 3 crores. While when you look at the consolidated basis, it has gone up from 11 crores to 19 crores. The reason for that fee and expenses going up is because in the fourth quarter, we were able to manage to raise assets in our AIF business for our equity business. So, and therefore, there is an upfront commission is payable, and due to that effect, the expenses are higher.
Okay, fair enough. Okay. Thank you.
Thank you.
Thank you. The next question is on the line of Jignesh here from NK Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just two quick questions. One, how is the trend happening right now on and this is not about March, but post this quarter, the fund has seen a trouble on the debt fund side. So how is the flow happening on the debt fund side right now in this quarter? Just a flavor, not the numbers. And number two, now, look, post-COVID, if you can give me some sense over how you're thinking about the distribution side, how changes would be happening, to reach to the end customer, if this kind of lockdowns or this kind of social distancing continuing. So any strategy over there that how you guys are planning to reach to the end customer more easily or more digitally, any platform has been developed or not? If you give some sense over this, that would be really helpful.
Perfect.
Thanks.
Let me take the first one on the fixed income. I think clearly, because of some of the events which have happened in the industry, we have seen the flows which are coming in. I think they have been moving away from credit funds and have been moving more towards the high quality and lower duration, you've seen. We have seen good flows in some of our schemes like Nivesh Lakshya, which are, more to do with, which are, and the guild funds. So there's clearly a change in which we have seen. But having said that, is this going to be a long-term trend? It's very difficult to comment at this point of time because this has just happened very recently, and many times these kind of change in behavior may be temporary or maybe permanent. Only I think we'll come to know after a couple of quarters. Coming back to distribution, we are very happy and proud of the digital capability that we built up over the last 5 years. The fact that I think we've been in this lockdown for such a long time, we still, I think, have been doing roughly about 10,000 subscriptions per working day without offices being open. We are doing roughly one incremental SIP every 20 seconds through our digital properties. So I think one good thing is that I think whatever investments we had done in our digital properties is showing results. Clearly, we will see more and more digital happening. But I'm also, I think the way I see is, I think once things come back to normal, whether it's going to be in 3 months, 6 months, I think nobody knows that. I think in financial services, there will always be a set of people who will like to physically come to the branches, to deal with the distributors, and everything cannot move digital. So what is happening right now, I think while it is a big advantage for us because of the investments in digital which we had done, but it is not that the branches will close. It will not happen that the people will not come, the distributors will not be having a face-to-face interaction. So I think we need to see how things play. I think it's always, I think you have to always keep diversifying and keep building and investing for future. So I think we are happy today both, whether it's a physical or digital. I think we are ready on both the fronts.
Understood. And just confirming it, the absolute loss number that is given for the other income part had been 149 crores. Is that number correct?
No. The overall number for the for the quarter is 125 crores on a consolidated basis. It is just that the question was asked that look, if we have earned other incomes, then what is the total MTM? So while the quarter number is this much, but we would have definitely accrued other incomes in our FD and tax-free bonds, etc. And therefore the question was on overall MTM would be how much.
Understood. And since market is already recovered in the month of April and May, we will see the reversal happening in this quarter, or we have to wait for it and all?
See, this quarter is still a long way to go. And, let's say if market grows up, significantly from here, the entire could be recovered. Or if it is, it's obviously it is very difficult to predict from our side. But of course, all those investments which we have made, we have, not realized these losses. So obviously these will be subject to MTM effect.
Okay. Understood. Perfect. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Adesh Mehta from Motilal Oswal Asset Management. Please go ahead.
Hello, sir. We have seen a very sharp drop in other expense from around 60 odd crores to 40 odd crores. And so, how should we read this trend? Should we conclude that, we have exhausted all levers in this line item and this should be the new normal, or, you have further levers to reduce this?
See, obviously we are working towards, more and more automation and more efficiency. So I don't think, we have exhausted all of it. Yes, incrementally, the delta from here will not be significant, and therefore, while we don't give any guidance, I mentioned that it would be in the range of about 45 crores to 60 crore, where we have the liberty of, discretionary spend depending how the market conditions are. But yes, despite on that 45, we still can definitely bring in some small savings by improving the efficiencies.
Right. And sir, we also hold some asset management rights of around 240 odd crores on our balance sheet.
Yes.
Right. So any write-off or provision provided on that this year?
No, see, we've got the external valuation done. And at this point of time, the carrying value is lower than the valuation carried out by the independent agency, and hence does not require any kind of write-off.
Okay. And sir, last question from my side. This 1,400 crores of debt exposure you have, everything is there in the scheme. You don't have any exposure directly to bonds or NCDs, right? Is that fair to...
No, we do not take any kind of bond or direct fixed income exposure or any equity exposures.
Okay. Okay, sir. Thank you very much. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Pratik Chavan from Banyan Tree Advisors. Please go ahead.
Hi, sir. Thank you for the opportunity. So, my first question was, given the uncertainty due to COVID-19, what would be the impact on our overseas mandate? Any sense on that? And the second question is in terms of market share. When we slice it up in terms of institutional, retail, and HNI, so could you share like what was the market share across the three categories in September, and what was it in Feb 2020?
If I got your question, market share between Feb and April, March.
Between September last year, sir, and Feb, in terms of HNI, retail and institutions.
No, I think broadly, to put it very simply, I think we over the last 2 years, let me break it. While you are going 6 months back, I'm going 2 years. I think the highest market share loss was in institutional investors and HNIs. And as we have mentioned, we are already seeing about 290 corporate investors coming back. And along with that, I think we have been seeing good traction coming in from HNIs, and even more, especially for a lot of HNIs coming in ETFs also. So I think while I will not right now have the number ready, which I think Abhishek can share with you offline, but these are the two segments where we can and will see highest growth.
So just to add to what Sandeep said, almost, as against the industry, our retail contribution to AM is about 24%. And, our B30 contribution is about 17.5% as against 15.6% of the industry. And in terms of retail, 24% as against 19% of the industry.
Then the first question, in terms of the offshore mandate, given the COVID-19 situation, any sense of what can we see in terms of next 1 year in the offshore mandate?
It is, as of now, no. I think since our last quarterly call, there's nothing much to share on that. I think, but as we mentioned in the last call, that I think with as Nippon being the primary shareholder, we are in the process of leveraging the global network of Nippon to get money into India. Clearly, this is going to be a function of how the overall investors see India. And so I think from a long-term point of view, we are very confident. I think we will gain market share in this segment, leveraging Nippon's network across the globe.
Just in case if you are interested, our UCIT equity fund, is being in quartile 1, from in 1 year category, in 3 year category, and inception till date category. So obviously, fund has been doing well. Obviously, if the opportunities come and, which is likely that India is likely to grow faster than the rest of the world, in case the money comes into India, then obviously this performance will surely help.
Sure. Thank you. That's it from me.
Thank you. The next question is from the line of Pawan from IIFL. Please go ahead.
Sir, thank you for the opportunity. A couple of questions. Number one is I want to understand how, this is a very basic question. I want to understand how the arbitrage funds are classified, whether they're as equity or debt. Another thing is solution-oriented schemes like retirement fund and children's fund, and closed-ended schemes. Are these classified directly as arbitrage funds classified as equity or debt in the asset classification that you show as average AUM?
Hello. Arbitrage, I think if you were to look at it, I think is included in the equity segment for our data.
Okay, sir. What about the solution-oriented schemes, retirement funds, and the children's fund?
Equity, whichever is equity will be equity-oriented schemes will come in equity, whether they're close-ended or a goal-based fund. All these are coming to equity. So retirement fund, which is an equity fund, will come into equity.
Yeah. Okay, so second question is related to investment, but not related to the MTM losses. Just wanted to understand the thought process here, because you have close to 2,400 crores or 2,300 crores in terms of investments, cash, FDs, but considering the cash flow, operating cash flow positive nature of the business, you don't really need that much cash on the balance sheet. are you considering extraordinary dividends or buybacks, whenever the share price goes below intrinsic value as per your estimates?
I think I will not be able to comment on this. I'll let the board decide this. And I think from our point of view, over the last many years, we've been giving higher dividends. And I think that thought process will continue. But however, I think that's very difficult to comment on that question at this stage.
Okay, sir. Thank you so much. That's it from me.
Thank you. The next question is from the line of Mr. Madhukar Ladda from HDFC Securities. Please go ahead.
Hi, thank you for taking my question again. We've been losing a little bit of market share both on the equity and debt side, and that is a little concerning. So, can you talk a little bit about what the thought process is and how you will regain this market share over the next couple of years? So, yeah.
So, Madhukar, if you were to see, again, like I mentioned, I think from if you were to break down the last full year, financial year, in three parts, I'll say from April to September, I think when this change took place for the Nippon Life, I think we came from an AUM of 240,000 monthly AUM to 182,000, and from there till 1st of March, we moved all the way up to 220, about 20% growth. I think so. Post last in 1 month, I think we have clearly seen. I think because of whether mark-to-market credit events happening. I mean, it's more industry phenomena. But I think the way you need to read it is, I think clearly, I think yes, we lost in past. I think if you were to look at the last 6 months minus the month of March, I think you can see the recovery story or to regain market share has already started. Even if you were to see the April data, I think that whether it's a few basis points, but we are gaining market share. So I think we are clearly getting our market share back. Having said that, I would like to also highlight the fact, while I think we will keep talking about market share, but as from a board point of view, I think the thought process is to continue focusing on profitable growth and profitability rather than market share. But I'm just trying to, both the sides. We have been gaining. I think we are seeing positive response. But for us, if it's between market share and bottom line, I think it should be bottom line.
Right. And just a follow-up. You said that obviously we're looking more at profitable growth. But if I do a little bit of a back-of-the-envelope calculation of this quarter's numbers and I try to derive the yield on equity, I believe that the equity yields have dipped pretty significantly in the fourth quarter. I have also seen, the commission sort of disclosures in terms of, normal TER minus direct TERs. And for March, commissions have also increased. So, can I get some comment on whether this is sort of a continuing continuing high commission payouts? Yeah.
Madhukar, I'll tell you that, look, what Sandeep mentioned is, our strategic intent. Technically, we'll keep working on, market was not good. We saw that there is an opportunity. Our scheme's doing well. In some of the schemes, to get the traction back, we might have gone and, slightly increase our brokerage structure. But, these are all tactical intent and we don't want to discuss this. But, strategically, if you see, despite the overall decline in the realization, our operating profit is about, for the quarter is about 29 basis point, and for the year is about 27 basis point as against 21 basis point last year.
Yeah, there is an improvement. Yeah. All right. That's it from me. Thank you.
Thank you. We'll be able to take one last question. We take the last question from the line of Mohit Surana from CLSA. Please go ahead.
Hi, sir. I just wanted your thoughts in terms of, you said that your digital initiative, etc., have helped during the lockdown phase. But just from a regulatory point of view of KYC, etc., and all of that, and that you mentioned that the fact that people, want to visit branches, etc. So I just want to know what has been your experience in terms of daily or weekly account opening rates, post-lockdown and pre-lockdown, and how do they compare, and your comments and thoughts?
I think while I will not have the exact number and data to share at this point of time, but clearly the fact that we've been in lockdown, we are doing about 9 to 10,000 transactions per day. We are getting incremental investors. See, what we have to understand is the digital system, ecosystem is also evolving and maturing. The eKYC. Today we have come to a point, it is a lot more smoother and easy for someone to, onboard somebody digitally than what it was 1 year back. So I would say things are, very positive. Regarding eKYC, it is not a challenge anymore the way earlier it used to be. So from the fact that in last year itself we added 1 lakh SIPs only through the digital on the digital properties. So I think it is evolving. I think we remain positive on this.
Okay, thank you. Yeah, thank you. That was all I had.
So thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thanks a lot, everyone. Thanks for being on the call Saturday evening so late, and hope to talk to you all again after the Q1 results in June. Thank you.